Sometimes companies make massive profits. We're talking numbers that far surpass their expenses, funds for future projects, and other investments. However, do you know what happens with that surplus money? One way in which this money is utilized is often in the form of stock buybacks, which is when a public company, you guessed it, buys back its own stocks on the open market. So what exactly are stock buybacks like? It's like throwing a party and then eating all the cake yourself. Well, it's a bit more nuanced than that. When a company buys back shares, it's essentially reducing the number of shares available on the market. Think of it as a pie shrinking. There's less pie available to be eaten. Additionally, each share that the company holds back turns into something called treasury stock, which has no voting rights. It would be silly if companies could control that much voting power, right? And no rights to dividends either. So what do stock buybacks have to do with your fundamental analysis? Remember our friend EPS, or earnings per share. Fewer shares mean the EPS goes up, making the company look like it's on a financial hot streak. It's like if you had a pizza and started selling it by the slice, but then decided to buy back a few slices and eat them yourself. Now, each remaining slice represents a bigger portion of the pizza pie. Delicious and financially savvy. But wait, there's a plot twist. Some critics argue that stock buybacks are the corporate version of a sugar rush. Sure, it's great for a quick boost, but what about the long term? Could that stock buyback money have been better spent on, say, research and development? Or perhaps a rainy day fund? Of course, companies try to budget for the future as best as they can, but it's way better that their money be efficiently used and not simply sitting around. So should you do a little happy dance every time a company you've invested in talks about buying back its own stock? Well, there is no simple answer. If you're in pursuit of short-term gains, or if the company is going through a tough patch, a stock buyback can be a smart move. You can take that money and put it into a more promising opportunity. But if you're the kind who's in it for the long haul because you truly believe in the company, things get a bit trickier. And it might not actually work in your favor. See, a stock buyback can mean different things. It could be a short-term sugar rush for the company. Or it might suggest that the company sees limited potential for expansion and is returning capital, which could mean less growth ahead. Or quite the contrary, it could mean the company's super confident about its future and believes its own shares are a steal. The bottom line is, it's essential to do your homework and really understand what's going on.